today I have the privilege of just being your host. Let me just also ask, as we do at all webinars, if you could please mute your microphones if you're not speaking. And also we won't hear your clicking when you type in the chat room then too. I have the privilege of just being a host today, but I'm going to go through a few just basic announcements, especially for those who are new to our webinar series. And then I'm going to turn over to my colleague, Lechi Zhang, and I'll tell you a bit more about Lechi in a minute. So if we could just move the slides forward. In case this is your first time, the Sme Finance Forum was created by the G20 countries, and it's managed by the IFC, the private sector arm of the World Bank. For the last 5 years and a bit, we've been building a global network of financial sector players who want to be the leaders in improving SME access to finance. And that network now contains more than 230 members with headquarters in over 70 countries, and they operate in virtually every country in the world. And it's getting harder and harder to fit all their logos onto this slide, but we have some pretty brilliant communications people who are doing a yeoman job at it. Now, our members, they learn from each other. They link to new business and partnership opportunities, and they get to lead the industry voice in high-level dialogue with important bodies like the G20, the Basel institutions, OECD, and others. And if anybody's interested in learning more about institutional membership, please feel free to follow up with us after the meeting, or you can write to SME Finance Forum at ifc.org or find any of us on LinkedIn or the chat. So I think my next slide is going to be our segue into this webinar. And I'm going to let my colleague Lechi Zhang talk a bit more about this, but let me just say a few words. You know, SMEs, particularly ones that are starting up, they have a hard time, and raising capital is one of the toughest things about that hard time. But we have been encouraged in recent years with how technology is enabling what many people, including most of this panel, talk about, the democratization of capital and the democratization of capital markets. Of late, there's been even more talk about how decentralized technologies can make a real difference, and that's DeFi for short. And is DeFi really the answer? Or can you do centralized finance with new technology, and that's going to be perfectly good? This is going to be something that this panel talks about in more detail. And who better to lead it than my longtime colleague, Lechi Zhang, our financial specialist, based in that growing North American fintech hub of Toronto, Canada. Lechi, let me turn it over to you to say a bit more about the topic and a bit more about our panel.
Thank you so much. Thank you so much, Matt. Yeah, so today's topic is about DeFi versus CeFi. DeFi is as a decentralized finance for short, as Matt mentioned. It's considered as a blockchain-based fintech technology that removes the financial intermediaries and provides services like securities, commodities via a decentralized manner. And centralized finance, as opposed to DeFi, really requires the trust in a centralized party. So according to CoinGecko, it's a crypto data aggregator, the total market cap of DeFi has reached about $128 billion today. And from 1 to 2 million users are interacting with DeFi protocols now. At the same time, the rise of DeFi has raised a series of questions, like how regulations are going to see this and how to define DeFi. Are protocols trustworthy? And today we are honored to have 4 distinguished speakers from decentralized finance field to share their insights about DeFi versus CeFi. And I'll first ask them to introduce themselves and their companies. After that, we'll start the conversation. So how about let's start with Centrifuge. Martin, are you there? It's your floor.
Let me unmute. Yeah, thanks for having me. Hello, everybody. I'm Martin Quenzel, co-founder of Centrifuge. Centrifuge is a blockchain startup. We started even before DeFi was a term and was known. And yeah, what we do is basically connect businesses and use actually the data like, invoices, etc., to be an asset and being financed on DeFi. So basically bridging the centralized world we are living in, we call it real world, sorry for that, with the virtual decentralized world of DeFi, and actually enabling real businesses to get financing from completely new sources, or from liquidity from decentralized sources in DeFi, in decentralized finance.
Thank you, Martin. Yeah, let's just take the order from the shared screen. How about next, Rako from Bitbon?
Hello, very warm welcome from Berlin. Very happy to be here as well and to be talking to you. On the slide, you see Michael Pinkers, our CFO, who unfortunately wasn't able to make it today, but yeah, I hope I'll make a good replacement. I'm Radko, I'm the founder and CEO of Bitbon. And at Bitbon, we also kind of build a bridge between the traditional finance world and the decentralized finance world. Our main focus is to provide tokenization technology to banks, issuers, financial intermediaries. And tokenization technology means that you create tokens which are digital representations of financial assets such as bonds or stocks or other financial assets. And once these assets exist in a tokenized form, you can also utilize them in DeFi applications. And I'm sure we're going to talk a lot more about that throughout today. I'm very happy to be joining the conversation.
Thank you, Rako. Gloria, thank you so much for taking the time in your evening time. It's the floor.
No problem. Hi, everyone. Very big pleasure to be here today. So I am Gloria Wu. So I work with Ontology project as the ecosystem partnership head. Ontology is a Web3 infrastructure. It's a decentralized protocol that enables all kinds of decentralized applications to be built upon it. And Ontology has been around for more than 3 years. We actually just celebrated our 3 years anniversary last week. The specialty that we have in our technology is decentralized identity management and also decentralized data exchange. And we believe these are very important elements, infrastructure elements for decentralized finance and decentralized a lot of different applications in the future. And actually, DID, decentralized identity, is also quite important for bridging what traditional financial markets sees as important for KYC, ML, and accredited investor validation, and blah, blah, blah. So I'm very happy to talk about that more today and discuss with audiences about the potential of DeFi.
Thank you, Gloria. Wes, our last but definitely not the least speaker. Wes.
Thank you, Lechi. It's fantastic to be here. Everyone, it's great to meet you all. My name is Wes Geisenberger. I help lead business development for Hedera Hashgraph. Hedera is a Web3 technology built from the ground up to achieve performance, security, stability, and governance that's required to scale enterprise DLT or blockchain technologies. On Hedera, both startups and enterprises are building and interacting with each other using services to achieve net new outcomes across different fields that are being approached, and use cases being approached in distributed ledger, everything from DeFi to supply chain applications and beyond, including things like scaling carbon markets, where we can bring in the concepts that we've learned from DeFi and bring them back to real world assets, such as creating guarantees of origin from solar panels or carbon offsets tied to individual projects.
Sounds very interesting. So without further ado, let me just start asking a few questions to the panel. After that, we're going to open the floor to the audience. So how about we start from Martin? I think you have very impressive achievements in both DeFi and CeFi. Could you just share a little bit about your understanding of DeFi and how it is different from the traditional CeFi applications? Thank you.
Sure. So, yeah, maybe I start with how it evolved, and where it is coming from. So everyone knows about Bitcoin and Ethereum. and all these ICOs we had in 2017, where people actually hold a lot of tokens and basically, cryptocurrencies, value, assets, whatever you want to call it. But the instruments actually to act with those assets, like acting with real world assets in real world using centralized finance, they were just missing in the crypto space. And then just, people start to build it. And no surprise, they called it DeFi. So what DeFi, I think, was emerging in 2018, I think, was starting to build was financial instruments as we know it in the traditional world, just in a completely decentralized way for purely crypto assets to better trade Bitcoin and all these other cryptocurrencies, to hold them, to have derivatives, to have swaps, to have abilities to exchange tokens, buy these tokens, provide liquidity, borrow, etc. So and then all these decentralized protocols for basically the crypto bubble itself, and all these use cases they're built, and it is what is really surprising, and also where these exponential growth is coming from, that just in I think something like 2 years, more or less, the crypto ecosystem was able, with all its variety of startups and members, was able to build a copy of the centralized financial system in a decentralized way for crypto, which was as powerful, maybe faster and more powerful than a centralized financial system, at least for crypto. And it is just reflected by this exponential growth. Where it came from almost zero to what is it now? If you look at DeFi Pulse, it is 55 billion now, which is just amazing, And I think if you look at DeFi right now, it's really kind of a financial system which works for crypto mainly. On the other end, what is decentralization? That's maybe the second question. That really means that you do not have a single point of failure anymore. So what you trust is basically that the technology is working, but the technology is not operated by a single player. It is running on the blockchain on something we call smart contracts, and that is actually where the calculation and the execution of the code is done in a decentralized manner, where then all these different nodes in the blockchain basically executing the code have the blockchain itself to find a consensus and to actually, then accept the transaction or reject it. It's very abstract what I'm saying now, but at the end, it creates completely new business cases, which are proven for crypto already, where I think, first of all, I mentioned already, you do not need an intermediary anymore. You are the owner of your assets. You do not need to trust someone holding your bank account, etc., etc. You have your wallet. With your wallet, you have your tokens, and you have full access to everything and have full control to everything. Number one. Number two is most likely that blockchain itself has created a lot of standards, ERC20 or EIP20. That is this most common token standard, where every protocol who speaks this standard can actually interact with each other, and there you can actually stake or compose. Actually, we call it composability. Can put those things together like Lego bricks, and build this Lego bricks. It's an abstract system of little colorful plastic blocks, but you can build amazing things, and that is exactly what you see with DeFi. And we haven't just seen the beginning. We do not know where it ends up. That is more to come, I guess. And what we work on, Centrifuge, you mentioned already, is really kind of opening it up for the traditional world, actually using those tools also for SMEs to be financed, for example.
Great. You mentioned SME, you mentioned the traditional real world assets, and we, just now we just briefly talked about some high level of DeFi. Could you maybe share one or two use cases you have, like to tell the audience exactly how it works, how you actually put the real world assets on DeFi protocol, or even, I know you're also working with MakerDAO and other DeFi partners, how all the partnership work? Thank you.
Absolutely. So we also, of course, first of all, tokenize those assets, but in most likely a different way. So if you look at the real world, you have those assets which are easier to tokenize because the assets itself are already tradable, already liquid. So stocks, for example, commodities, etc., there you most likely can straight create an ERC20 token, meaning a fungible token, stable coins is another good example, and just start trading it. We are more focused on those assets in the real world which are non-fungible. Yeah, you have a single invoice, which is, even if the issuer and submitter of the invoice and the recipient of the invoice is the same person, it's maybe the same date, it's still definitely, different goods being paid with this invoice, etc. So where every invoice is a unique, non-fungible thing on its own, and that is true for every of those things. If you lease a car, if you finance machinery, etc., etc. And then we create the first step, then we originate those assets, or we call this party actually an asset originator, and then they do that using our protocol. They create a non-fungible token. That's not a standard. It's called ERC 721, if you would like to know that. And actually, this non-fungible token is really a digital twin, a digital representation of this unique asset in the real world. And then actually our protocol is able to pool those NFTs because financing a single invoice is just a cumbersome for an invoice, for an investor. Matching $50,000 invoices, even the single investors, is quite of a challenge. So really, we create what we call pools. They're on the blockchain. It's all managed by smart contracts. Of course, those pools of NFTs can have a much higher value, millions already. So the TVL in our protocol, we call it Tin Lake, is I think just crossed 25 million. And then consider all those invoices being NFT tokenized in the first place, put into a pool, and what you invest in as an investor is really that pool. And that pool is a little bit more complex. So first of all, it enables really on an ongoing revolving basis to put NFTs in, lend money against this NFT, get it paid back, burn the NFT, put another one in, like acting with a financing institution when you would like to finance in invoices, do factoring basically. And on the other end, also investors could do exactly the same thing. They can invest in a pool, redeem their investment whenever they want, and if there is liquidity, and to make that a little bit better, in the middle, we build a simple securitization mechanism. So, that from asset-based financing, from actually structured finance as well, there we created a payment waterfall with 2 tranches of kind of investment opportunities, a token which is a senior token, basically providing a fixed income. And that senior token is protected by a junior token, which has to take the first losses. First of all, senior token is paid out, then the junior token. But the junior token, if you look at the underlying assets, so meaning the NFTs and what the NFTs are actually paying for the loan, that is something where, of course, this junior tranche should be satisfied for the higher risk within higher return. And that is where we also, of course, then having different investors, where those junior investors or junior token investors are typically more institutional investors, investors being closer to the assets, being able to participate in the underwriting, understand the asset and the structure much more deeply than the senior investors, the fixed income investors, and also do the composability with other protocols. You mentioned Maker, for example. We look at those senior tokens first because it's just easier to handle. So what it means is really that then those investment tokens just travel to another DeFi protocol, and then this DeFi protocol gives actually the money in exchange, and they take care on how the investment is structured. Yeah, and use cases are, I mentioned already, invoice financing, trade financing, real estate, but real estate rather short-term maturity, like bridge loans. Music streaming is financed, revenues, future revenues of SAS companies are financed, things like this,
Very, very impressive. Yeah, I think we have one question for Martin. I think we still have a little bit of time. I think you see from the chat. Could you tell the audience a little bit more about the current scale potential in terms of the aggregate envelope and could be available to, say, retail individual investors through this kind of like I would like to call it like the DeFi version of the structured finance, or ABS.
Mm-hmm. So what was the question? The potential to invest, or?
Yeah, like for retail or individual investors.
So retail individual investors, how that works is they of course need to know how crypto works, so at least have an Ethereum wallet and how that works. First thing they need to do is go to our platform, and they are the decentralized app, tinlake.centrifuge.io. Go for a pool they are interested to invest in, and then actually it starts with KYC AML. So it's like, you know, opening a bank account. We partner here with Securitize.io. You actually go to their platform. You need to identify yourself with, you know, uploading a selfie, your passport, proof of address, etc. Go through that process, and if also in the case you already have a Securitize ID, and I think long term, I think digital identities will play a much stronger role here, a much more important role here. Maybe another question for the panel. Is actually, you know, the connected wallet is whitelisted to the smart contracts to invest in. The investor is identified as an investor who is allowed to invest in a specific asset, you know, because there are sometimes limitations if it comes to jurisdictions, residency of investors, etc. And then the investor just invests with connecting their wallet, pay with a stable coin, receive the investment tokens in return. They hold the investment tokens. So in a senior token, for example, that is generating a fixed income, and that means the token price is raising. So they buy it for price A and sell it for price B, and the difference is exactly the return. And then they hold it as long as they want. And if they would like to return it, they just give it back to the protocol and get more stable coins in return. And stable coins is, for example, DAI or USDC.
Awesome, thank you. Yeah, go ahead. Sorry, Martin.
Yeah, and if you'd like to try it out, let's go there. I think there's a lot of opportunities to invest.
Great. Thank you, Martin. Yeah, so I just switched the gear a little bit. And Rako, I know Bbond has a very impressive track record helping SMEs to access finance and also building the legal bricks, if I'm allowed to borrow the words from Martin, the legal bricks that you are building to implement different security token offerings, STO, recently, not just in Europe, but also in the rest of the world. So what's your take on future development of digitizing real-world assets for startups and SMEs?
Yeah, so if you look at how capital markets functioned in the past, then typically public market funding, meaning that you would do a bond offering or a stock offering, were, I would say, financing tools that were only accessible to companies and corporates that made somewhere north of, let's say, $100 million in annual revenue. So the entry barrier to access this form of funding was relatively high. And that's one of the benefits that tokenization brings, is that also SMEs and smaller companies actually now have the tools at hand to address a much larger and ultimately a global investor base. And the reason for that is, and for the entry barriers that you typically had in capital markets, was you would need to go to a bank. The bank would need to act as an arranger, as it's called, which means that they support the company in order to go out and cater to both retail and institutional investors. And of course, banks are an important group who is utilizing tokenization software for the traditional bonds and stocks that they help to issue. At the same time, though, smaller companies, and obviously we have a strong focus here on SMEs with the Sme Finance Forum, they can likewise utilize this technology and say, well, we might have a lot of investors who may want to invest into us as a company, but we just didn't have the right tools to make those investments work and to pretty much give investors the opportunity to invest in us as a company. But the tokenization technology is of course something that has a much lower entry barrier than this ballpark 100 million in annual revenue. Of course, there needs to be something. It does have to be a company that has something to show for to investors, and there needs to be some form of substance there. But I would say that even a company that makes, I don't know, $1 million in annual revenue could, benefit from tokenization technology and then make a public bond offering, a public stock offering, and gather investors locally, but also internationally. And so this is one of the advantages, looking at it from an SME angle. The benefits that tokenization can bring is simply the fact that they can start accessing public capital markets in a way that it simply wasn't possible before.
Wow, interesting. Very impressive. And Gloria from Ontology, just want to ask, because I heard and we have read a lot of things about your credit-based DeFi lending protocol and how DID can potentially help a startup to raise capital. Could you just share us what you have done about credit-based DeFi protocols and how DID play kind of important role in that? Thank you.
Yeah, sure. Traditional finance has a lot of things that are quite mature in the kind of product offerings that we're seeing in the real world, right? Now you don't really borrow anything that is fully collateralized. For example, like you wouldn't collateralize $100 to buy to borrow $100. That's just not how it works. There is a very important element that's called credit in the traditional financial markets. So you could demonstrate that you have certain assets, value of assets. You have certain trading history, and your basically all the information, even on your credit card, to show your consumption records, what kind of things you have been buying, and you have a job. That job pays a salary that is like monthly to pay for your credit card bills, and you have a very good track record. Right? So that sort of things are enabling credit-based lending and borrowing. That's something like a default in the real world, but it's something still yet to happen in the decentralized world because we don't have a track record for individuals to show what kind of investors they are. There's not even a way for, I would say, regulators to know, or different platforms to know what kind of investors you are, what's your risk tolerance level, and is it too risky for you to participate in certain financial products. So these are all potential that could be filled in the future, and those are missing currently. So we see decentralized identity and the credit-based data that is associated with your decentralized identity is very important as a infrastructure pillar for decentralized finance to really rise up to the maturity level of offering as centralized finance. But we also know that people are increasingly feeling uncomfortable that they're disclosing so much information to different financial institutions, to different authorities to show that they have certain credit, right? And all these information are being converged in the real world, and you feel like you're basically, giving out all your privacy of your transaction history to get a higher credit. So in the decentralized finance world, if you're using decentralized identity management and different financial institutions and different service providers could request your credit score based on your different data and your history with your entire control. So you have sovereignty over the identity and the associated data, and you can basically also use zero-knowledge proof technology to show the results based on certain pre-agreed algorithm and credit calculation models to demonstrate your qualification to the service providers without revealing any of your privacy data. So we see this as a much better solution, not only to DeFi to have better offerings, but also to really solve this problem in the real world, that all your data is basically stored in the financial institution's centralized client and server. So for Ontology, because we have been trying different ways of having decentralized identity adoption, and we're definitely looking at potential use cases in DeFi. So since last year, we have developed this borrowing and lending platform called Wing.finance. So it has several different pools. The first one is a traditional over-collateralized lending and borrowing pool. It's called a flash pool. It's very similar to many other offerings like Compound and other projects out there. But we also innovated to have a second pool called inclusive pool. So in this pool, you can have yourself KYC'd you can have yourself associate different on-chain asset data so they can compute a certain credit score for your transaction history. And you can use such a score to have a portion that is not collateralized and still enable you to borrow. So this is one of the use cases that we're seeing of very promising potential. And the field is actually also discussing a lot in terms of new ways of credit-based lending, because this whole over-collateralized model is very much involving like a point broker role, which is pretty much outdated already in the traditional world. I can't hear anything.
Legal breaks. Yeah. Can you hear me? Yeah.
Yes, now I can hear you.
Yeah. So we just talk about DID. We talk about KYC, ML. We also talk about legal breaks. How about regulations? What's your take, Gloria, in Asia, APAC region? Do you think, so some people just have made some bold predictions saying, oh, maybe in the future, DeFi are all be supervised or put under certain kind of like security regulations. Do you agree with that, or what's your take on the future?
Yeah, that's an excellent question. Thank you, Lechi. As many of the previous panel speakers said, right? So the difference between DeFi and CeFi, you can also imagine it's like removing the intermediary agency, and which in many cases really reduces the bureaucracy and redundancy in the processes. And now we're in such a digital world, you can send messages to anyone in the world like in an instant second, right? But you can buy things in e-commerce sites like in an instant second. But we cannot even transfer funds and money and purchase different financial products from everywhere in the world in a very simple way. This is obviously obsolete, right? This is obviously like a something that is very bizarre to see in the current day technology. So there's a lot of space for decentralized finance, removing this into like this middle agency and having different was previously mentioned, like a Lego, right? So different players can plug in, and you can have a very easy to access and smooth experience of purchasing different assets. But yeah, and I also want to mention that the importance of DeFi is because of this CeFi redundancies and bureaucracy and inefficiency, you're actually depriving a lot of population from participating in the financial market. But we all know that now, the capital gain is actually grow much faster than income for a lot of people. So if you're depriving people the right to access financial markets, it's almost like depriving them the right to catch up with the inflation and CPI growth, and like basically making them poor day by day. So it's important to have that sort of infrastructure, but we definitely see that you also need to consider there is the need for counter-terrorism financial procedures. You need anti-money laundering laws, and you need to also have a way to tax people. And different countries have different financial regulations about like capital control or accreditation of different investor qualifications, and like all kinds of rules, right? But these rules, if you translate into like a centralized finance process, these are paperwork, like endless paperwork, and very time-consuming to do. And also different financial institutions have different booking systems and databases. They need to do the settlement of these different transactions, and it takes a lot of time and energy and costing money as well, right? So these are all inefficiencies, but people were always kind of under this impression that DeFi is so unregulated and it's not possible to address such problems. But actually it's not really the case. So with such technological protocols such as decentralized identity, right, you can actually do that. You can program accredited qualifications for investors based on different financial products and cross different jurisdiction borders, and have a very easy way to manage them, right? And different financial institutions can use the public ledger to really reconcile and have like, you know, transparency over the transaction settlements. So these are all possible, but we're yet to see the adoption. So I definitely see that this is the way forward. And we should work with regulators to help them to understand the technological offerings, right, by blockchain and decentralized technologies. So there are solutions out there that just need to be informed. These are possible, and their way of regulating the market also needs to be, you know, catching up with the latest technology advancements. So that would be my point of view.
Thank you, Gloria. I think Rako from Bibon, I think your team have worked closely with regulators, with the regulated entities on the STO front, security token offering front. What's your take, Rako, on regulations? And I know Germany or Europe in general have taken kind of more progressive way or attitude towards DeFi. What's your thoughts on that? Thank you.
Yeah. So of course, in financial markets, regulation is always playing an important role, at least. And in some cases, regulation can foster certain technological developments. Taking Germany as an example, but then also referring, of course, to other jurisdictions, Germany recently passed something that is called the Electronic Securities Act, which legally allows for the dematerialization of all kinds of bonds. So what has changed is that earlier, when a company issued a bond as a public offering, such a bond would have to be deposited with something that's called the Central Securities Depository. And these are these CSDs, as they are called, have a relatively monopolistic status in each country. In the US, it would be the DTCC, for example, and almost any country around the world have their own CSD. The CSDs in the earlier days have fulfilled a pretty important function because they allowed to transfer securities in a electronic way. However, today with tokenization, we have tools at hand that are even much more advanced than to what CSDs do. And regulation will need to progress further in order to allow for the tokenization of securities. And then this plays also a role in the field of SMEs, because if SMEs want to utilize the technology that we and many other companies have built in order to issue tokenized bonds, tokenized stocks, then of course they need to be able to do that in compliance with the local regulations. And therefore, the technological development and the regulatory environment, of course, needs to go hand in hand. And in some countries around the world, this is the case. Germany is by far not the only one. There are many other jurisdictions. Looking at it from a European perspective, you have Switzerland, Liechtenstein, Luxembourg, and a couple of others where tokenization is a reality already and where there are no barriers. At the same time, though, there are countries where a CSD would still be required. And of course, that you know, kind of prevents the whole idea of tokenization, because one of the reasons you enable smaller companies to go to the public capital markets is by making the whole process more cost effective. If you still need to integrate the same intermediaries, though, then of course this promise of a more cost effective financing tool does not really hold. And so regulation is an important component, and I hope that many lawmakers around the world and regulators will actually follow the example of some other countries around the world and will allow for the tokenization of financial assets in order to improve the financing situation of corporates and SMEs.
Very insightful observations. Thank you so much, Rako. Just a related question, but a little bit different, is on sustainability, environmental issue. I think we have seen a lot of people criticizing the energy usage of Bitcoin and a few other cryptocurrencies. So do you think DeFi can become greener? Like Reco, I know Bitbon used to be lending in Bitcoin, but then recently, I think in some ICO projects, you have started to use, let's say, Stellar and other protocols, maybe more efficient, more kind of higher performance. What do you think about this kind of change?
So, of course, sustainability is something that also the finance world simply cannot afford to ignore. Energy consumption is one big issue, I would say, that needs to be addressed. And Bitcoin, of course, being the most prominent and the most well-known cryptocurrency, at the same time is also by far the digital asset that creates the highest level of energy consumption. As a side note, one thing that we also must always consider is, of course, how the energy that the Bitcoin miners are consuming is produced. You have a spectrum from renewable energies, energy sources that go into that, but also you have very, I'd say, conservative energy sources such as coal power plants, for example, which obviously from a climate standpoint are extremely problematic. And it's, there are no, I would say, reliable studies to the exact proportion of which types of energy sources go into Bitcoin mining, but it's also relatively clear that at least a large portion, or at least a significant portion, comes from rather environmentally unfriendly energy sources. So it is definitely one topic that needs to be addressed. Another topic is not all blockchain protocols are made the same. There are different approaches how consensus is formed on a protocol. And Bitcoin is using a consensus mechanism that is called proof of work, which is extremely energy intensive and consumes a lot of energy. There are other approaches such as proof of stake or Byzantine federated agreement, which are technological ways to form consensus on a protocol, which are far less energy intensive. And companies like us who utilize protocols as a tool in order to help companies issue tokenized securities and other tokenized assets are very well advised, I would say, to also take that factor of sustainability into consideration when evaluating which protocols to use. And at Bitbon, we have done very comprehensive evaluations of a lot of protocols. To put it in a very short, today there are two dominant protocols that are being used for tokenization. One is Ethereum and the other is Stellar. Again, there are many others. We could talk, just for an hour about different protocols, but just when you compare Ethereum and Stellar, Ethereum as a network currently also works under the proof of work mechanisms, so technologically relatively similar to Bitcoin. And just Ethereum is estimated to consume roughly 0.1% of the total global energy consumption, which is relatively significant. While Stellar, which uses a so-called Federated Byzantine agreement for its consensus mechanism, which is far less energy intensive, uses as a whole network roughly the energy that is equivalent to one US household. So if you compare those two, we're not talking about 10–20% difference, but we're talking about orders of magnitude different. And therefore, I believe that, not just looking at technological features and capabilities of these protocols, but also the sustainability aspect taking into consideration, companies like us and others that are utilizing protocols as a base layer to provide services and software should take that into account and should always lean towards protocols that also from a sustainability standpoint are much more responsible.
Yeah, totally agree. Thank you, Reco. Talking about different the making of consensus mechanisms, Wes, from Hashgraph, I know you have a unique mechanism, and Hashgraph has also done a lot of work combining DeFi and green finance. So it seems that you have made DLT a positive force in promoting sustainability. Could you share a bit more about Hashgraph and how you work in green finance? Thank you.
Yes, absolutely. And just to echo Roscoe's comments, I think there's plenty of plenty of opportunities for different layer ones or public DLTs to bring a positive impact and have a low carbon footprint. For example, Hedera, a cost per transactions in terms of kilowatt hours or energy consumption in a public network is 0.00017 kilowatt hours from a DLT perspective, which is less than that of the Visa network in a traditional finance setting. I know that from a Bitcoin perspective, we're looking at well over 800 kilowatt hours. And so we're talking about orders of magnitude of difference. And the reasons Hedera is able to do that in our public mainnet as a public layer one is because we consider the requirements for a public DLT to scale. We think about things like performance, like security, stability, and governance that are all underpinned by the Hashgraph consensus algorithm, which takes two key innovations of gossip around gossip and virtual voting to make this all possible. And the outcome is we're able to do tens of thousands of transactions per second and even go beyond that in the coming years. We're able to get finality, so all transactions, we don't need to wait for any extra blocks to be confirmed. We're able to achieve finality in a period of a few seconds. And we're able to do that with the security of asynchronous Byzantine fault tolerance, the highest form of security in distributed ledger systems. And we even have a mathematical proof to show for it. That means there's no leader in the distributed ledger. We don't have to worry about different attack vectors because we're at the mathematical limit. We back this up with stability and ensure that there's no forking of the network from both the security perspective and through our strong governance. And at the same time, our governors, who are the owners and initial node operators of the network, and they're the owners for a period of 3 years and can be re-elected for another 3 years, are these Fortune 500 companies in the region globally, diversified across industries and across geographies. And if you can go to the next slide, Karina, appreciate it. What they're governing, though, is the hash graph. And a hash graph, just to differentiate from a blockchain or traditional system, and to echo what Rocco was saying, is these proof of work type of algorithms. These algorithms are designed to be slow. They're competing to solve a math problem, and efforts to speed them up don't allow you to have these things like asynchronous Byzantine fault tolerance. They're designed really to make sure that you get to the correct agreement of what transaction goes in what order and what block goes next in the chain. It requires heavy electricity usage because miners are trying to solve to get the correct answer to this math problem, and they need certain amounts of hashing power, and they're all competing globally for this. In Hashgraph, what we're doing is we're taking this gossip about gossip and virtual voting to enable this fast finality and high security in transactions. What gossip about gossip really means is we're taking a little bit of extra information as we share transactions across the network. We're taking the last transaction that we sent and the last transaction received, just a hash of it, and we're able to pass it on as part of a message. And then every computer in the network is able to understand, well, where did the message come from? We take the median timestamp to confirm finality, so we don't have to have any extra receipts or votes, which means we don't need any extra electricity usage. So we have all sorts of companies, if you're able to go to the next slide, that are actually governing and building on top of this network. These are the quote unquote owners of the network who only serve for a 3-year term, and we have new governors and operators who come on each year. Some of the more recent operators that we've added over this past year are folks like Standard Bank in South Africa, EFTPOS, the payments network from Australia, Electricité de France, one of the largest global utilities. We even have universities like University College London, and these folks are all spread all over the world working on different use cases. But what they're really doing as part of the initial governors of the network is they're ensuring that there's no forks. The software and the roadmap is stable. We're bringing the features that really support their use cases, not just as governors, but folks who are building startups like Avery Dennison, who built Atma.io, which is a startup in the supply chain space. And they're thinking about the carbon footprint even of every product that's produced that has an Avery Dennison label on it. We're thinking also about the different decisions from a regulatory perspective and what the fee model should be. Because today the fees are denominated in USD. So it's a penny of a penny, 0.0001 USD to submit a transaction on the network. And that is paid in HBAR, a native cryptocurrency. And all of these folks are building on top of the services layer of Hedera, if you could go to the next slide. And so all these folks are excited about bringing the roadmap to bear on top of the consensus algorithm with our two primary network services, our consensus service and our token service. And what we're doing is we're building real world use cases where we're able to take small pieces of data. Maybe it's a proof of a bill of lading in a supply chain network, or maybe it's proof of energy creation from a solar inverter to produce a guarantee of origin or a renewable energy certificate. And what we're able to do is take these data proof points, and oftentimes we're able to tokenize them. Many applications are interested in tokenizing things like renewable energy credits, or maybe doing trade finance in supply chain. And we're able to tie this data to individual tokens, and we're actually able to link them using decentralized identities. So just to piggyback on Gloria's focus from Ontology, this is something we also see as part of the future of both DeFi, tokenization, and how we scale distributed finance. We're able to take these assets that we create, and when you have something like a tokenized renewable energy credit, or maybe a tokenized item that maybe Atma is tracking in their supply chain, we're able to do things like calculate the carbon footprint in emissions generated from a supply chain event, and we're able to match that with something like a carbon offset or a renewable energy credit, and then go burn these assets tied to real world events to prove that we're actually in real time offsetting a given asset, all on ledger. We're able to do this without sharding. We're able to take these real world assets, tens of millions of solar panels or different IoT sensors tied to factory production lines, and we're able to bring them all together in a transfer of real world value, tokenize them, and create a different type of outcome than what we've seen in crypto today.
Awesome, thank you, Wes. Could you maybe share just maybe one use case that about how DeFi can help accelerate green finance? Or I think you have one of the case with energy companies, right?
Absolutely, yeah. So we work with a lot of different energy companies in the space. A couple examples are companies like Rectify, which is a small startup compared to maybe the biggest of big in terms of companies like EDF. And these companies are looking at how we can create new types of carbon credit marketplaces. And one of the recent advances in research that we're focusing on is the concept of fungibility and multi-attribute matching for things like renewable energy credits. And so we've been doing a lot of research into areas like automated regression markets, which is a new concept where we have similar but different assets. So something like a renewable energy credit, you may think of as fungible for the most part, right? Each one is going to be represented as a megawatt hour, but there's different attributes tied to, say, different solar panels. Let's say if you had a solar panel and I had a solar panel, we wouldn't necessarily want to, be duplicates. In the case of green finance, we have this concept of double counting, and the Paris Agreement created the enhanced transparency framework to avoid these types of issues. So even though our assets are similar, you might want to know exactly where your solar panel is, and even if we're next door neighbors, we want to know that they're different, maybe when the energy was produced. We maybe want to be able to go to market and say, mine was produced with more efficient energy generation versus, maybe an older model solar panel, and that way we can understand the difference between a single asset. We have great companies like Rectify who are building these marketplaces, focusing on getting to a true carbon price where these different parties who don't know or trust each other can better connect on the authenticity of the data tied to these renewable assets, these green assets. We can also decide exactly how much they're worth, and we can create markets that can buy and sell independently of an individual user. And ultimately, based on these attributes, many companies who are working in the space want to be green, but they don't necessarily want to buy a carbon credit from halfway around the world. What they want to do is be able to buy based on the price within their region, focused on a high quality asset that they have traceability for, that they can tie back to a specific timestamp on a DLT with the attributes tied to a decentralized identifier describing the asset and signing for the asset in the form of a verifiable credential produced on chain.
Awesome. So talking about working with different partners, Martin, from Centrifuge perspective, I know you have been working with a wide range of partners, from factoring company to music company, you said. I think a big question here is, are they ready? Or are most of the projects still at the so-called POC, proof of concept, that kind of stage? What's your take on this, Martin?
Yeah, I think we started with fintechs, which were able I think we look at it at not creating something which is more efficient, which is cheaper or faster, than, you know, a centralized line of credit, where we most likely approach it right now as something where we just unlock value, where the centralized financial system isn't able to deliver. And that is primarily SME space, fintech space, etc., where we just been able to support use cases the traditional banking system wasn't able to support, like, you know, financing music streaming is a good example. And now we're getting more and more mature, talking to more bigger partners. So in the next coming months, we also kind of, you know, tap into, I think the triple digit of millions asset originator size, where it is pretty much a kind of, I think, competing with traditional finance. And that also shows the maturity of the system, where then, of course, there's efficiency and I think, you know, easy to access, speed, and immediate kind of, you know, execution of transactions that comes to play and plays a more important role, I think. So I hope that answered the question. Are the asset originators, the partners we work with, ready for blockchain? I think the one we're talking to, yes, but if you look at the majority of them out there, of course, it's a learning, you know. So it will be more and more, but currently, I think most of them are not prepared for this new world.
Yeah, thank you, Martin. I think that the following question with Rako. I think Bibon started to work with regulators and other like regulated partners, I think, from day one. Even in your previous business model. And I know Bibon has switched to STO and focus more on working with regulated like banks or other financial institutions on issuing bond on blockchain. So what's your experience on working with like so-called traditional financial institutions? What's their say the opinion, or have their attitudes changed over the past like a few years?
So I think it makes sense to differentiate between two different aspects. On the one hand, we see a tremendous amount of openness towards new technologies, because I think there's a very strong consensus within the leadership and also the employees at traditional financial institutions such as banks, that the new technological capabilities that are here to stay. And we're not going to stick for the next 5 or 10 years with the legacy systems that are in place today. So that's something that I believe is very well understood in the industry and is also accepted, and a lot of people are actually pretty excited about it. Because banks, in many cases, have been asking for a dematerialization of securities, have been asking for removing the monopolies that CSDs have in many parts around the world. So these are things that are surprisingly progressive, and these are aspects that I'm very positive about. Then there's a second aspect, which is how fast will this change happen and how fast can the change happen? If you look at especially the IT systems of banks, typically they have dozens of systems that are involved when you think about issuing bonds, equities, settlement, and all these aspects around capital markets and capital markets financing. And this is something that takes more time than it might seem at first sight, because banks are relatively large organizations for the most part, and if they just replace one building block of their value chain, if you look at settlement, for example, then this is not something that can happen overnight. It's not just, yeah, let's take the best protocol out there and let's take a tokenization software, or let's take custody software and then let's just start doing that. But there's a lot of processes that need to be adapted to it. There's a lot of educational work that needs to be done. So we're talking more about timeframes of 2-3 years instead of just a couple of weeks, you know. And this is a big difference between, you know, SMEs or startups. In an SME with, you know, just a handful or 10, 15 employees, you know, when such a, you know, small or medium-sized enterprise makes a decision, then they typically start working on the implementation the other day, and then normally in a couple of weeks or a couple of months at the most, changes have been made and new technologies have been adopted. But with banks, it's taking much more time, and this is something that I believe everybody needs to be aware of, and that everybody needs to factor in when, on the one hand, they work with such partners, and on the other hand, also for the companies that work with banks as their financing partners, that they need to be aware of that banks simply need time due to their complexity and size in order to utilize new technologies and in order to implement changes.
Interesting. So I probably just want to maybe drill down a little bit, and I'm going to invite other speakers to shed some light. Basically, in terms of the say the acceptance of blockchain in the financial services industry, I just want to ask, do you see kind of some shift from like the private blockchain instances to more like a public chain use cases? Because I think in the beginning, like about 5 years ago or 6 years ago, when we first kind of tested blockchain within the World Bank and other financial institutions, we tend to focus only on the private chain solutions. But today we're seeing more use cases on Ethereum, on some even public chains. Do you see that kind of shift? Probably like Reco or Martin and others, feel free to add. Yeah.
My quick take is clearly yes. I think a few years ago, banks were thinking, well, when they utilize blockchain as a technology, it has to be on a private permission chain. But I think until today, they have recognized some of the advantages of public permissionless protocols, very comparable to the typical internet protocol stack that builds on top of TCP/IP. And all the tokenization transactions where we were involved in, and also the meaningful ones that we see in the market, were actually all done on public permissionless chains.
Yeah, I think I can support that, So I think the battle between permission consortia and permissionless open blockchains, that is already over. So it's like, extranet, intranet, it just, a closed network with an open technology just doesn't make sense because it's not generating the value it is built for. You can use a database, don't need a blockchain, to build a closed consortia. That's it, period. And that's why none of these consortia has really worked out and it has proven to generate any value. They've just been stopped without any real success. Wherever you look at, doesn't matter.
Interesting, Martin. So, how about Hedera Hashgraph? Because I know you have like I would say like more like centralized governance console, but at the same time you are designing like a more like permission public chain. So, can you explain more about what is permission public chain, right? Because sometimes these two words don't really come together, right?
Yeah, so happy to explain. And I'd actually say that we are on a path to permissionless at Hedera, or a proof of stake network. So our initial node operators are these large governing council members who are really bootstrapping the network for success. We have the Googles of the world, the Shinhan Banks of the world, all these enterprises diversified across geography and industry who are actually governing diversified over time. So these node operators and governors are the owners of the LLC, but they only serve for up to 2 3-year terms, so 6 years in total, as governors of the network. As we scale to a full governance council of 39 governors, what we're actually doing is we're adding nodes around them in our next steps. And those will be KYC permission nodes as we scale into hundreds or thousands of nodes, and even beyond that into the unpermissioned steps of scaling a public network that can do tens of thousands of transactions a second, support millions of accounts and assets and applications. These are all different things that we see as upcoming and building for Hedera. Today we've done almost 1.4 billion transactions in our history, and we support over 300,000 accounts on the network. So we're scaling in the current permission state, but on the path to permissionless. Now, to address these consortiums that are being built using frameworks like Hyperledger Fabric, Corda, and Quorum, we actually see these as perfectly interoperable with the public world. And what we see is people building hybrid networks that can interact with these third-party applications built on open and fully public instantiations of applications. And so what we see is folks using things like the Hedera Consensus Service as a public global ordering service for Hyperledger Fabric, or Corda from the notary perspective, or Quorum. And what we see is the opportunity to create assets where parties who maybe don't want all their information out in the public, they want to keep private transactions private, or maybe within a certain geographic jurisdiction for their own regulatory reasons, is able to create these assets, and then they can bring them out of those protocols or share information as needed into a public ledger setting where we enable interoperable use cases.
Great, thank you. In observation of the time, I think it's time to maybe open up the floor to audience. I don't know if we have any questions from the audience, from participants. Just want to let you know that the questions you can see from the right hand. There's a chat box. You can open it up and see the questions. Speakers also feel free to pick up questions yourself from the chat.
So Luci, we had a question a while back that was very interesting. Although it sounds very basic, but it's actually quite a complicated question, I expect. There's a question about whether, if you are a possessor of these tokenized assets, you have the same rights as possessing classic shares in a security.
It depends on the regulation, right? Yeah, Martin, feel free.
Well, let's and what about in principle? Can you have, if regulation permitting? I guess the implication of the question is, do you really have the same rights as a shareholder? There was a bit of implied skepticism in this question. So that, if I was reading it correctly.
Maybe I could first of all address it, because it has two sides. I think the question, if it is about crypto, you do not use a custodian. You're really a user of DeFi, as DeFi is designed to be. You own the asset, period. There is no immediate. You own the token. That's it. There is no custodian, bank depot or whatever managing the shares for you. You own it. Representation of something which is not on the blockchain, so it's not really crypto, like tokenized bonds, etc., then it's of course the legal framework which is behind.
Reko, you have anything to add?
I would just have said the same thing.
Awesome, great. Yeah. Okay, let's move to maybe another question.
So there's what is the app that would cause governments to provide infrastructure for the widely deployed self-sovereign ID? That sounds like a good question for Gloria.
Could you repeat the question again? Yeah.
The question is, what is the app that would cause governments to host, or well, I'm literally reading it. What is the app that would cause governments to host/provide infrastructure for widely deployed self-sovereign ID? But I think maybe the meaning is, what has to happen for some of these independent modes of ID and KYC to really take off?
I think it's also towards like a broader question for adoption of decentralized applications. It's not necessarily only towards usage in DeFi. You could actually, like as people, as society, right? We could actually have a dialogue to participate in how the rules of the game are being made in terms of where your data are being stored. Right now, because of the property of not having a state layer in the current internet, you have to rely on centralized client servers of different service providers, such as Facebook or Google or WeChat to host your data to provide a service customized to you. But that's increasingly criticized by the public, so you cannot always know what's the arrangement between these big players, because there are such monopolies, and if they have given your information to someone else, right? So it's kind of like public society's rights. You need to articulate with the public policymakers to have the decentralized solution in place. I see that as a broader, I don't know if I answered the question, perfectly, but I think that's the broader question for society to really step into the decentralized web world.
I think that was great. And we also had a related question. I don't know who wants to take this. I mean, how does the KYC process that you all are involved in actually work? Who actually checks the validity of the documents or screens the investor? How do you do this in a DeFi structure so that you don't, I mean, the famous saying is on the internet, the cartoon on the internet, no one knows you're really a dog. I'm saying that with two dogs sitting below me right here. How do you really know that this has been properly vetted and confirmed?
So in a simplified way of explaining this, like let's say institution A wants to sell a financial product, a dematerialized financial product digitally to Bob, and Bob is the accredited investor. So the institution A will need to verify if Bob is an accredited investor based on certain criteria. So institution A will ask different data source providers like party C or party D, who are basically licensed licensed data providers that has a database or record to show Bob is Bob according to different verification requirements like passport or identity card or some other ones or biometrics. So institution A will issue a request to party C, and party C will ask Bob to provide the relevant information, and Bob will be sending that information to party C, and party C will issue a verifiable credential including Bob's certain information, and Bob can disclose that information to institution A. So institution A can get that information needed, but that's like entirely authorized by Bob himself. But this credibility, the verification of the data credibility is coming from the party C. And this party C can be all kinds of organizations. It could be traditional KYC providers in a market who are basically doing this exact thing for banks and other financial institutions. It could also be schools, universities proving certain diploma. It could also be your employer demonstrating that you're a worker in their company or having a certain revenue arrangement with the organization. So it can be basically anyone. In that way, all these credentials for Bob are having their status registered on the blockchain, and the validity can be also verified on the blockchain itself. So that's like a simplified way to explain that.
Very interesting. So you still do need these centralized databases, but once it's on the decentralized ledger, then you don't have to keep doing it again and again, presumably. So that's where the efficiency comes in.
Exactly. That's the reusable KYC case. Thank you for mentioning that.
Yeah, Martin, I'm Martin. I just want curious. What's your experience working with service provider like Securitize? Do you think they're going to be like with the development of the ID in the future, maybe the working model is going to be different in the future, you think?
I think the ID would give investors or everyone who wants to use a specific protocol requiring KYC or something like professional accredited investor check, etc., just more flexibility. And right now, our investors don't have flexibility. They need to go through a specific provider, in our case, Securitize, and do it like they do it, onboarding to the Securitize platform itself, or kind of, pretty much the same like opening a bank account with an online bank. And they do both. They do KYC, but also actually in the case of US investors for US offerings, that this US investor, or the entity, accredited investor, so has professional investor status if you compare it to other jurisdictions. So they do that all, So it's reusable. So in a sense, for the centrifuge platform, the entire protocol is kind of connected to centralized KYC AML service Securitize, so that if you did it once, you can actually invest in all the pools on Centrifuge TinLake. But if you would like to go to another protocol KYC, you most likely need to go through the process again. And that is where, of course, the digital identity would help, an identity token. You can just, unfortunately, I'm there yet, so go to it.
This is clearly a topic we're going to have to return to. I know there's still questions coming in. We're going to have to wrap up, though. What we will do is, if there are any questions, we always preserve the chat, and if there are any questions that weren't answered, we will be sending them to our really great speakers, and they will hopefully be able to respond to you. So apologies if we missed any questions. I'd really like to thank Martin, Radko, Gloria, Wes, and particularly Luci for putting together a really fascinating, this is just the beginning of getting into this topic, but quite clearly there is so much potential to enable the utilization of much smaller ticket assets in a very efficient way. Both to enable those that want to securitize the assets to do it in a more affordable manner, but even more important, to enable smaller investors to have a way of getting into areas that conventional centralized capital markets and other instruments don't let them get into. So clearly something of major interest to SMEs, because they have both those problems, right? Lack of affordability of going IPO or whatever, and also difficulty in accessing finance, because limited to only centralized sources like banks may not enable many SMEs to get the sort of financing they need. So great. Thank you so much, everybody. I'd like to just a few announcements before we send you on your way. First, we always appreciate your opinions. So if you see that Survey Monkey in the chat and you have a chance to tell us about what you thought of this and how we can do better, we always listen to you. We have some very interesting events coming up soon. Sorry, I'm jumping around in the wrong order. But tomorrow we have the second edition of our live session of our 24/7 virtual marketplace. You're going to be able to listen to some really exciting young fintechs telling about what they do. And also you can, in the marketplace, connect directly to them and follow up if you think what they're doing is interesting, whether you're a potential investor, whether you're a user of the service, or whether you just have questions. So that's going to be tomorrow at 0800 Eastern Daylight Time, not Eastern Standard Time. So it's GMT -4 to be a little bit more digitally accurate here. And then next week, we're going to be back on tech things, but it's going to be at a little higher level. We're going to be talking about big tech and big banks and where it's all going. And we have some big bankers from places like Wells Fargo and BBVA, and we have some big tech from companies that started out outside the SME finance space, but are major players now, like our member Grab, like Mercado Libre from Latin America. It's going to be a really interesting session. I urge you to register and take part. And then we've been encouraging all those institutions that are engaged in capacity building. Please think about becoming a signatory to the Principles for Learning. This is something our IFC colleagues who are working on capacity building initiatives around the world have developed, and it's a way of building another sort of network to help make capacity building work better. So you want to find out more about that, you can see in the chat. There's a linkage there. And also find us on Facebook. We've decided to go mass market. We're not just LinkedIn now. Go to Facebook, follow the SME Finance Forum page and see what else is available to you. Hopefully you're already following us on LinkedIn. We have almost 15,000 in our chat group now, our discussion group, but and a number following our LinkedIn page, but we hope you'll follow us on Facebook too. And with that, again, let me thank all our speakers. Let me thank a very lively and engaged audience. And let me wish you all a good morning, good afternoon, and good evening, wherever you are. This has been a fascinating session. We are clearly not even started on where DeFi is going. It's a really exciting area. It's going to have particular applications for SMEs. So it's something I'm sure we'll be revisiting many times in the future. Thanks for joining us. Have a great day. Stay safe, stay well.